Reserve Bank of India will likely maintain status quo on the policy repo rate at the end of the Monetary Policy Committee meeting that concludes tomorrow. It's much awaited. Most economists expect the MPC to keep policy repo rate unchanged at 6.5%, drawing comfort from the gradual easing of inflation. Joining us to discuss the possible outcomes, I have with me Sakshi Gupta, Principal Economist at HDFC Bank. Sakshi, great to have you with us. Let's get a sense from you first on what the RBI is likely to do. Do you also feel that a status quo is inevitable?
Yeah, good evening, Gaba. Thanks for having me on the show. Yes, absolutely right. I think tomorrow's policy, we are going to see the RBI keep the repo rate on hold at 6.5%. Clearly, from the last policy, both inflation and growth seem to be moving in a favorable direction. We have seen inflation prints coming in below 5%, and they are likely to be, below 5% even for the last month. On growth, we saw an upside surprise for the FY23 numbers, and the momentum continues to hold on, given the high frequency data for the month of April and May that are coming out. So I think in this policy, the RBI will just wait and watch and look for greater signs of this downward momentum in inflation that we are seeing currently, and whether that's sustaining, and just remain on hold.
Okay, what does this mean for the economy though, Sakshi, given that, we are seeing real GDP stronger, consumption however is lagging, it's a better trade scenario, and the services sector that's really uplifting growth. Do you feel that there could be any potential lags or any kind of impact of the earlier tightening that the RBI has already done that could still play out over the next few months?
You're absolutely right. I think that the transmission and impact of past rate hikes is going to play out over the coming quarters. I think we already are seeing some impact seep through in terms of consumer demand that seems to be moderating. And I think that given the global scenario and the headwinds in terms of at least goods export, we are going to see growth gradually moderating through the year. However, we continue to perform better, I think, compared to our peers, a lot of the Western economies. So no more rate hikes, and is broadly growth supportive. Although that being said, I think the transmission process will continue to weigh on consumption going forward.
Interesting, and I also noticed how you mentioned tapering growth, because that's something that everyone's got their eyes on. How worried are you about the global scenario, and where are we when we're talking about monetary policy in line with what we're seeing globally? What could we further anticipate, or what could be some of the pulls and pressures that the RBI has to keep into account?
Right. I think that given that, we are kind of looking at an impending, slowdown, recession in the US, already in Eurozone, we are seeing Germany has already got into a technical recession. Now, these countries are a major trading partner for India, and therefore there are headwinds in terms of our export growth going forward. Moreover, I think if you just look at what the European Central Bank and the US Central Bank are doing, they haven't really ended their rate hiking cycle as of yet. And I think that, in an effort to broadly align ourselves with the global tightening, it is unlikely that the RBI will look at easing monetary policy in any way, this year. So we are basically going to remain on hold, at a pause, and any sort of pivot is unlikely unless and until the global monetary policy cycle starts turning. I think the financial risk, we saw an increase in the risk in the US with the regional banking crisis in the month of March. I don't think that risk has completely gone away. There could be some, impending risks from that end, tighter credit, conditions. And we've, if you just look at even the forex market, the dollar index has been very, very firm, which has meant that there is some pressure that is continuing on the rupee. So a number of risks on the global front. Of course, domestic economy, the bigger risk now is the monsoon and how that really performs, and I think that's going to be extremely important over the next 3 months, both for inflation as well as growth, and would determine the future interest rate paths for us here in India.
All right. Sakshi, so what are your net expectations on inflation given some of these factors at play? Where would you place it? Inflation has been on the decline, but if we look at some kind of a range for the next few months and perhaps, till October or so, what would you anticipate?
So I think the next 2 prints are going to be particularly, benign, between 4–4.5%. There is clearly a base effect and some downward momentum that we are noticing in the data. Beyond that, I think a broad range of 4.5% to 5.5% is where I would expect inflation to be. This is, of course, assuming that the monsoon situation is, continues to be normal. We don't see a sudden spike in commodity prices globally. So if any of these assumptions are busted, there are, of course, then pressures to the inflation range that I am talking about.
Sakshi, banking liquidity, and you touched upon what's happening in the banking space, but also talking about liquidity was in surplus, rising to the tune of about 2.5 lakh crores. That's at the beginning of June. What's the picture there going forward?
Right. So, if you look at what was happening to liquidity about a month back, we were seeing liquidity conditions tightening quite significantly. But since then, I think a number of factors have supported an increase in the liquidity surpluses, in the banking system. So, clearly, I think some of the FX interventions that we saw from the Reserve Bank has added to the liquidity position. We've also seen more recently the withdrawal of the 2,000 rupee note has led to a sudden increase in the liquidity surplus in the system. I think going forward from here on, my sense is that as we move into the end of this quarter, of course, there are quarter-end tax-related outflows. So some of the current liquidity surplus that you are seeing could come down. Over a more medium-term perspective, my sense is that structurally liquidity is going to tighten from here on, and I would expect it to be below 1 lakh crore on average in the system. I think that the RBI would want to withdraw and continue with its stance of withdrawal of accommodation so that there is greater transmission of the policy rate hikes that it had delivered in the past. So I think just to keep inflation and inflation expectations under control, it is likely that they will continue to intervene in the overnight market to manage the liquidity situation and keep it in a slight surplus.
Okay, fantastic. So clearly what you're saying is that while we're expecting a status quo, it shouldn't be misinterpreted as easing in any way whatsoever, given a whole host of these very serious factors that continue to really influence the RBI's move. Thank you so much for joining us, Sakshi, and we wait to hear what comes out of the MPC.